2 years ago, our keynote speaker was brought into the Securities and Exchange Commission not to maintain the system, but to improve it and take it to the next level. Under his watch, the SEC is pursuing digital onboarding, youth inclusion, transparency agenda, and more, asking not simple but radical questions like, what if the capital markets indeed work for everybody? He has spent over 3 decades in the financial regulatory machinery, so he not only understands how it works, he makes it work better. Today, he has been asked to address each and every one of us in person and virtually on what it does take to build a nation that investors, local and international, actually want to back. Building an investable nation through policy, reform, and resilience is the keynote title, and I'm delighted to welcome the Director General of the Securities and Exchange Commission, Dr. Emomotimi Agama, to speak to us this morning. Please receive him very warmly this morning. Boss, please confirm that you can hear us clearly. Can you hear our applause for you, for your intervention, for your charge? Thank you for lending credence to the conversation today, letting us know that the SEC is ready. A few words that I heard or I put together from all that was said: power, clarity, signaling, which is communication, letting the world know we are ready. Sophistication, yet simplicity. And nobody should ask, what are they doing? Why? You are part of it. So you can't be saying, what are they doing? It is, what are we doing today? Please, again, appreciate our keynote speaker, the Director General of the Securities and Exchange Commission, Dr. Emomotimi Agama. Thank you, sir. Our first panel is coming up right away, and I'm sure they will take some pointers from the keynote into the conversation being had. I am delighted to welcome the moderator for the panel, which before today I have only seen on television. I see him on Channels TV, where he reports from crypto markets to other markets. Amazingly, he has an economics background, and so he brings to bear his wealth of experience in the conversation. Please join me as I welcome valuable asset, business journalist, Channels Television, Laddie Williams. Mommy, I made it. I'm with Laddie.
Thank you. Well, good morning, distinguished guests. It's great to be here. I want to thank the FSDH team for putting this together and also trusting me with this panel session. Good morning, everyone. It's great to see all of you. You look great. You look intelligent. And this is a great time to be an intelligent investor, a time where risk assets are becoming safe haven, and safe haven assets are becoming risk. It's all bumbled, at this point. So you need to get that experience, and thank you to the FSDH team for putting this together. So I'm going to be handling this panel session, and it's going to be informative, that's for sure. I'd like to call on Mr. Hakeem Mohammed to come on stage here. He's the Executive Director, FSDH Merchant Bank, someone I've spoken to a lot on TV. Welcome, sir. Please keep clapping for him as he comes up. Welcome. I'd like to also call on Mr. Chai Gang. He's the Deputy Director, Payment System Policy at the CBN. Please put your hands together for him. He leads the Innovation and Initiative Management Office within the Payments System Policy Department. Please put your hands together for him again. All right. I'd like to also call on Isyamo Omorigbe. She's a co-founder, COO at Bamboo, a digital investment platform that gives Africans real-time access to trade in the US, local assets, and also for their personal finance, and they can also use their personal devices. I'm sure, who has a Bamboo app here? I'm sure. Yeah, a couple of us do. Yeah, welcome. All right, so I'd like to call on Mr. Sheyi Ebenezer, he's the CEO, Pay-Aza Africa, a seasoned commercial banking expert and fintech entrepreneur with over 15 years of experience in driving innovation, business growth, and financial transformation. Trust me, their profiles are much bigger than what I've said so far. Thank you all for being here. Definitely, we're going to be talking about a very important topic now, and this has to do with a smarter market. In my mind, a smarter market is a market where money flows easily, through, and everyone is able to participate in that kind of market. So we're going to see how we can bridge the gaps between banks, tech, and investors at this point. That's very important right now. Thank you all for being here. It's great to have you, very intelligent people. First off, I would like to start with the lady in our midst. Ladies first at this point. Ms. Yamo Omorogbe. So definitely we keep talking about, smart. Everything is getting smarter. At this point. Talk to me about what a truly smart financial market, what that looks like, especially for a Nigerian context.
Yeah, that's right. Okay, perfect. Hello, everyone. Good morning. Hope everyone is doing well. Thank you very much for having me. Thank you, FSDH, for putting this together. So when I think about a smart financial market, it's really not just about technology. Obviously, technology is important from a distribution perspective, but a smart market is one where capital is able to move securely, it's able to move transparently, and it's able to move effectively. And a big part of that is trust, right? So you have to trust that the systems work, that things are going to happen, that when you move your money from point A to point B, that it's going to go well. The second thing is liquidity, right? Because you need capital to be able to move efficiently from where it's sitting. So in most times, it's just sitting in the bank, or it's sitting under someone's mattress in any case. But you want to be able to move capital from wherever it's sitting to where it can be most productive. And a smart financial system, a smart financial market is where we're able to do that, and and the average consumer is able to trust that when they do enter a position, they're able to exit said position. So trust is important, liquidity is important, and the third thing I believe is access. Access is really, really important for a smart financial system, a smart financial market. We're still in a position where there's a lot of gains occurring in the capital market, but it's still largely being reaped by institutional players or super rich people. But as we said, as the DG said in his speech, how do we get Nigeria to a place where you have 20 million people participating in the capital market? How do you get these 20 million people to being able to deploy their capital and being able to make that capital productive? Because at the end of the day, that's sort of the contract we have of capitalism, right? We say that, yes, you can build these massive organizations, and these massive organizations can grow off, quote and unquote, the back of the average human. People think about food, and the average person that is buying, let's say, Boa Foods, right, in your day-to-day. But the contract we have from capitalism is that these massive conglomerates can grow, but the average person can decide to own a part of them. So as the conglomerates grow, the average person can also grow their wealth to them. And a smart financial system allows people to do this and trust that it happens.
Right. So looking at Nigeria now, a scale of 1 to 10, how smart are we? That's for the market.
I think we're on the way. I think tech has helped. I think platforms like this has helped. We've seen that there's a lot more retail participation in the capital market. For us at Bamboo, that's a big thing that's important for us, improving retail participation in capital markets. SEC has done a lot of regulatory work to help improve trust as well in the market. So I think we're on the way. I'm not sure that I want to give a score now, but I think we're on the way, and there's always room to grow.
All right, maybe I'll just give us a 6-7. 6-7. 6-7. All right. Let me come to Mr. Sheyi Ebenezer now. He's the CEO at Piazza. For you, what would you like to add, to what she said, so far, looking at Nigeria?
All right, thank you. Firstly, I just want to say thank you for having me, FSDH team. My major understanding and then what I would like to contribute in the first instance is I do ask myself questions very, if you talk about the financial market, it solely rely on trust. And then my first question I ask anybody regarding trust is why do you think a thief have a bank account? So if you can ask the question and say, why do you think a thief have a bank account? The only reason why he has a bank account is that he or she does not trust he herself that if I keep this money somewhere, it's going to be safe. So I'd rather keep it in a place where I can go and knock the door, collect the money, and then go out. So that's the basis of any financial system. So if you can be built on trust, like my sister said, so that's the first leverage. Number two, which coming to the context of what we're discussing today, co-creating and everything, the second highlight is infrastructure. If you're going to talk about smart anything, there was this day I landed in DC, then I was going to New York. I couldn't fly, so I was driving down. And then all through that journey, I never had probably 3G, buffer, anything while I was on the Zoom call. That was the day I understood infrastructure. So if you're talking about smarter anything, so infrastructure had to go alongside with any trust on the first side, infrastructure on the other side, then the collaboration of the two, then we talk about smart financial system and ecosystem. Thank you.
All right, thank you so much for that. I'd like to come to Mr. Hakeem now. So we know there are a couple of parties that play in this market that's trying to make markets smarter. You have the banks, you have technology, and you have the investors. But looking at it holistically, we see that there's a gap somewhere. Some of the participants sometimes they work against each other, or they're not able to collaborate. What do you think is the problem there? Why do we have the gap, and how can it be closed? Try it again. All right, we'll get a handheld now for that. Okay. Okay, let's get a handheld.
Can you hear me? Yeah.
Oh, okay.
So let me speak with this. So I think the biggest gap that I see, in the system today is maybe has to do with interoperability. So whereby okay. So I think the biggest gap I see is about interoperability, which is the concept around if a bank has done something, she should be able to rely on some of the things that we've done. So today, for example, it makes no sense that the same customers who bank with a commercial bank are the same customers that you are serving or that Yomo is serving. But at every point of the way, I will do the KYC, she does the KYC, you also have to do the KYC. The question is, why are we not sharing? Right? And that for me is one of the biggest problems that I see. KYC is one of them, and there's also the issue around how you also share even financial data, because there are some things, for example, that you as a bank, you see of these same customers, right? When this customer is going to buy stocks or something on Bamboo, the Bamboo app, there should be, that customer should already be profiled such that the system should already know, what is Hakim's risk profile? What are the sort of securities that he may like? Okay, is our next trader, this is what he does, he must enjoy risk. So let me push more sophisticated securities to him. For me, those are the things that we need to do, and it's the work that we all have to do. One, as banks, the fintechs, even the regulators. So the regulatory sandboxes, for example, that we have today, that the SEC and Co are championing, central bank, SEC, they all have all of that. It helps to nurture innovation. It allows people to be able to put in what it is that they're doing and try to see how they can push it straight into the market without necessarily being constrained by the fact that, they are trying to do it all by themselves. The fintech may have done something. So we have, for example, one of those, I think it's YouVerify, that are already doing KYC today. So the question is, why can't others plug into it? Why do you have to start it all over again? At FSDH, for example, we are deploying API to fintechs, whereby we're helping them to use some of the KYC that we've done. So on the BVN, for example, they can plug into our system, so that way, if you're trying to verify me, I just only need to put in my BVN number. You know who it is that you're talking to, because a bank has done the work. So the fintech doesn't have to necessarily go and replicate the same thing.
So, personal experience.
Yeah.
I've had to do KYC on so many platforms, and sometimes it's so frustrating. You've registered on this other platform. Yeah. They're like even a sister company. At this time, you have to do the whole process all over again. What's the solution to that? Is it open banking? What do we do?
Yeah, so those are some of the, open banking is one. And like I mentioned, there's already...
I'm sorry, how do I trust that company A has done the right KYC, so I'm not inheriting something that's not complete?
So this will have to be championed. There has to be a sit down, like what we're having today, where folks, the banks, naturally, because of what we do, we tend to bank, some of these sort of kind of customers. So there has to be a sit down between the banks, maybe the regulators, to be able to, again, one of the things to be worried about as an individual is if I put my personal details on this platform, how am I sure this guy is not using it for some other ulterior motive? Which is where, a regulated entity comes into play. Because you're sure that the central bank, for example, would ensure that this particular bank that I'm giving this to, that they protect my data. So data protection clearly is one of the things you'll be worried about, and it's actually one of the things that you want to ensure that you get right, so that going forward, folks like you and others who may have this sort of concerns will be maybe better suited for this sort of thing. So because the issue that you have is that you don't want to put in, you hear about systems being hacked every now and then, and there's that fear that, if I give this thing to one random fintech that I don't know, that is run by, by somebody who is not even, maybe not a banker, just some, school kid that just got out of school, smart, can code.
There's so many fintech apps out there.
Absolutely.
So many.
Yes, but I think generally, with banks, because banks are better regulated, right? I think folks are generally more comfortable when these sort of initiatives are led by banks, because they know that central bank, again, you probably may want to add to this, but central bank has, protocols that you need to follow, and they come every now and then to check that you haven't breached any of those. When people get more comfortable, then they'll be more willing to pass on their data to this sort of initiative.
Yeah. Keyword, comfortable. I've had so many people come to me and say, Ladi, I want to start investing. Show me, where do I go? Okay, get on this app. They're asking for my BVN, Ladi. I don't want to give them my BVN. They're going to hack me, stuff like I've had, heard that a lot, at this point. But let me come to Mr. Chai Gang. Now, definitely from a regulatory perspective, innovation moves fast. And most of the time, there's that debate that regulation sometimes slows them down. So, in your view, how do you balance, innovation, being fast, and also protecting, the system?
Okay. Thank you, FSDH, for bringing CBN here. So, innovation, a lot of the time, precedes regulation. And the resolve that we at the central bank have been able to do over the years is to ensure that through the process that we are there to create the enabling environment. So even at the point of design, even at the point of regulation, we build regulation in such a way that there's stakeholder engagement from the beginning, so that builds trust. And then innovation is built into compliance by design, so that if you are co-creating from when the ideas are coming up and you're doing it together, so there's need for alignment between the regulator and the innovator to be in alignment when the process is being developed, such that when innovation happens, innovation has taken into recognition guardrails and compliance by design. So processes from the beginning have already been retrofit to be compliant by nature. Also speaking around, so part of the other questions you asked was also looking at shared infrastructure. It's very key, and that's part of the learnings we've taken from the payment system. We've been able to build quite a number of shared infrastructure. So even when it comes to digital identity, when it comes to instant payment, it's been able to lower the entry barrier for new entrants, lower the cost of transactions, because it's a platform that multiple entities are connected to and are required to connect to. In the beginning, it was hard getting people to connect. But once everyone was able to see the vision and understand that we stand to benefit from this, then trust was enabled, and then people were able to fully integrate, such that today, any new market entrant that's coming through the payment system is able to plug and have access to multiple payment rails.
All right, so would you say we've seen an improvement, when it comes to innovation and regulation kind of meeting, somewhere in the middle?
Yes.
Is that what you're saying?
So the process is continuous. So even, for instance, the payment system vision first went live in 2007, which involved multiple stakeholder engagements and really letting the market lead the way in developing regulations for a future payment system. Now, why I say it's continuous, because even though we're doing all of that, we've also embedded a regulatory sandbox, which also gives us a better eye into the future of innovation in digital financial services. We're also doing open banking, which also has shared infrastructure for open banking registry, for consent management, and the like. So it doesn't stop. As innovation keeps on evolving, regulators also have to evolve and make sure that they're also innovating as well. So you don't just leave the innovation to the operators, you also have to innovate, and then you also have to design regulation to co-create with innovation.
Fantastic. The regulator has to also innovate, at this point. Let me come to you now, Yamo. So we know there's friction most of the time between traditional finance and fintech. We're trying to, close that gap at this point. For you, what does collaboration mean, to make markets smarter?
I think it will be helpful it's always helpful when there's collaboration around, specific market bottlenecks. Like he spoke about infrastructure. At the end of the day, collaborating to help improve market infrastructure helps improve things for everyone. So sometimes we still see a lot of the time, we still see that a lot of collaborations are mostly partnerships. They're mostly bespoke. So it's like, TradFi company A, having a partnership with fintech B, and it's bespoke and it works for both of them. But I think the most effective type of collaboration is where, we agree on specific bottlenecks. So it could be KYC, like he spoke about. It could be payments. It could be, various things. There's different distribution things we need. There's a lot of information, lots of data that sits with big banks, for example. Whatever the specific bottleneck is, actually working together to fix that bottleneck and making it available to the entire market, so that it's actual infrastructure that everybody can build upon, and that will help improve market efficiency.
Right. And I guess personally for me, I'd like to also see collaboration when it comes to transaction fees. Because if I'm sending money from my bank into a trading app, I'm going to be charged there. When I get to the app, I'm also charged. Trading, selling, buying, there's a charge there. So personally, what do you think can happen when it comes to transaction fees, where the investor is not charged every time? Is there a possibility there?
I mean, so I think fees are a thing that generally reduce as markets grow. As markets start to grow, as volumes grow, you see that naturally fees start to reduce. The example we always use is phones, right? When SIM cards first came and when telecom started, SIM cards were so expensive. It was like how much for those first MTN SIM cards? Like how much? 20,000. I don't remember how much it was. It was a ridiculous amount. But right now, the SIM card is essentially free. And you buy data, you buy credit, and we've even seen like over time, data credit starts to drop. When you look at somewhere like the US, for example, where the market is big and the market is trillions of dollars, they're paying you to trade, not the other way around, because like order flow is important. So I think as markets start to grow, as businesses start to get bigger, as volumes start to grow, you will see fees automatically just start to reduce as a function of the free market, because this business still have to exist. Right, so right now there's multiple layers of fees, but fees are the first place that people compete at the end of the day. And so as that competition starts to grow and those volumes grow, fees will start to reduce.
Right, that'll be great to see, because I've seen a platform where you got a charge for depositing and a charge for taking money out, of that platform. I can imagine how it makes life difficult for investors. But Ebenezer, for you, what's the way to collaborate?
What you're saying, because one of the fundamentals that investors look at is how profitable is the platform, how profitable is the institution, and then profit is being earned from fees. So we have two types of fees: non-interest and interest, at least. Yeah. So in that vein, like she said, once we I've observed that Nigerians or probably Africans, we can pay for efficient service. Once the service is very efficient, you tell your market in the sense that, okay, the people who are price sensitive, who are not price sensitive, but often than not from the research that we've done in terms of the payment and then B2B payment that we do. Because when we're starting off, we look at two things. Price war is a race to bottom. So we look at the side of efficiency, and then we play on the side of efficiency. We see we got almost about 4 investment grade rating. We're able to participate in the market. We see what has been able to happen in terms of efficiency. And then the merchants who ride on in terms of fee, when they didn't get the service, they were on one side. So they had to then begin to onboard with us for efficiency, time up, settlement, T+0, like that, T+1. So merchants begin to pay for quality service. For instance, I pay for quality service if the service is uptime. Instead of somebody promising, as in we see happen in Nigeria, we promise 5G or 4G, and then you are still even dialing. I can dial you and I'm still cracking up. So, but people rather just either roam their line, even though they land in Nigeria, and then still roam their line and then pay for more service to do that. So that's on that part. And then fast forward to what I think Akim talked about, infrastructure sharing and everything. So recently I was reading about the data, and then owing to what the MD spoke about this one, that next year we're going to hold them accountable for the discussions that we have there. So the first thing I want to hold them accountable for is that how many data centers have we been able to support next year? Because what has happened over time is that if you look at, for instance, US has almost about 4,800 data centers, where all of these, our infrastructure, all of the data that have been hosted on. If you come to Nigeria with almost 230 million population, that we have, US has over 300 million, Nigeria has close to 270 million population, we have just 49. Out of those 49, functional is 25. Out of the 25 that is functional, the crack up is about 13. So you could see the number going down. So interestingly, so most of the data that we're thinking we're priding on here, some are just hosted, most of them are just outside the country where we're talking about. So interestingly, and then we've read all around the world, the next war is going to be a data war. So the best we can put our own infrastructure, owning institution like Madam Smith accountable, that how many bond, how many infrastructure, okay, fine, this is what I want to support, so that will enable people like Central Bank to just be able to govern what we are doing extremely well, because the bottom line of every GDP, GNP is to be able to identify where your volume of money is per time. And a case in point is I did analysis of, if you look at the volume of domiciliary accounts open in 2023 versus 2024 versus 2025 has nosedived drastically. But if you look at the volume of money that come into Nigeria, has gone up. So the question is that, where is the money?
Very good question.
All right, no, I'm asking, so those are the things we need to know.
All right, so it'd definitely be better to have most of our data within and not outside, since we tend to import a lot of things.
These are long-term projects, so most of the merchant bank do a short-term. I mean, you see, they say time, because I was once a banker, so time loan 1 year, term loan, let's say 3 years. You can never say any 7 year or 6 year. If you give an infrastructure fund, they say, oh, no, we cannot. So you understand. So we have to just change. As we are talking about the change and we want to hold ourselves accountable, so hence why we need to position some of the fund within our balance sheet for a long-term funding. That is obtainable in the West. They do that. And then I think it starts from the regulatory environment where CBN is not penalizing something. Because if you pick a JP Morgan, for instance, a bad loan or let's say a bad debt there is sterilized and is not recorded in the following year balance sheet, even though they recover it. It's being sterilized elsewhere to fund a long-term project or to fund sectors that are very sensitive, like agric. You can't give agric a 2 double-digit facility and then there's nothing they can do with that. You can't give an infrastructure fund a double-digit. The last time I sat with Funke Okweke, she's sold May 1 down to MIT. She's lecturing now. But the stress of power, all of those things, it has to be a long-term project, which is what we need to hold ourselves accountable for at least next year. And by God's grace, I'll be here next year to ask the question.
Patient capital. A lot of people got called out right there. All right, let me take you to Mr. Gang now. So talk to me about how the CBN is posturing to empower a better connected and smarter banking system. And you can also respond to some of the comments he made.
Okay. So let me first of all respond to the issues around fees. Fees can be a bottleneck for a number of customers, especially with the way we want to scale financial services. It excludes instead of including. Central Bank has a regulation around guide to charges by banks and other financial institutions where it places a cap for how much you can charge for certain services. However, the most ideal would be some sort of liberalization or an interchange model where there's guarantee of service, because even within that pricing model for where there's a cap, for instance, when you come to an MSC fee, certain operators may choose not to pay that minimum and zero it out because they have an arrangement with the merchant. But then all the enablers of that transaction do not, when there's nothing charged, nobody earns anything. So interchange in some jurisdictions has been the way to go, where you're guaranteed to earn something from that transaction. Now, sorry, what was the question again?
Yeah, to build a smarter banking system.
Okay, so to build a smarter banking system, collaboration is essential, bringing the industry together. So for instance, we have the Bankers Committee, but just recently, sometime last month, CBN was able to inaugurate the Payment Service Provider Committee, which will function similar to the Bankers Committee, but would address issues within digital financial services, provide a direct line of communication between operators and CBN management to resolve the issues within that industry, and then also help with developing regulation and just bouncing off ideas of each other. And that helps, it builds trust, and by the time regulations come out or some initiative or innovation, everybody's already aware and accepting of it. So that makes it, it creates a smarter environment. It creates other issues around creating a smart financial system is also ensuring that systems are democratized and those that are excluded are also considered, because currently you may not see value in that. But once we're able to have scale and people are fully included, it will expand the market beyond what we imagine. Other ways to also expand that smartness is also to consider co-creation, not just with the regulator. So, because sometimes operators are so fiercely competitive, they're unable to see that there are partnerships that they can build within themselves. But it just needs that alignment of expectations. For instance, there could be an ambition to expand beyond Nigeria and export some of the financial platforms and services that have worked in Nigeria. If I can't do it alone, or some other entity, maybe a bank which is more risk averse than a fintech that is more agile and is more innovative, if there's a collaboration to say, and an investor too that relies on consistency and predictable outcomes, those three can combine and say, we see an opportunity here. We don't have to always compete. We can co-create together. So it's not just, but it also requires a regulator that would act as an enabler and as a catalyst to not just build the infrastructure, but to also inspire the market to move in a direction that is positive for the economy.
Thank you so much for that. I'll come to you now, Mr. Mohammed. So definitely we keep talking about trust. I'd like you to paint a picture of what that really means, for this for these stakeholders, and when it comes to investing, because I can demonstrate trust with you. If you give me $1 million, I'll give it back to you tomorrow. You can trust me. How do you define trust between these stakeholders?
Okay, actually, trust is the bedrock for financial services. Once there is no trust, everything breaks down. So the reason why, for example, you may not be comfortable giving your personal details to some fintech is because you don't necessarily trust them. But because if you see names, FSDH, and any of the commercial banks that you're comfortable with, because you've been there, either because you've banked with them, or you know someone who does, and they've told you every time I went into that institution, I get my money out. So you've built that trust. So that trust is really the reason why you keep going back there. And for me, that's the basis upon which financial services run. Once trust breaks down, as counterparty, so I'm a bank A, I'm dealing with bank B. The reason why I'm able to say, I'm selling dollars to you, or I'm taking funding from you, or I'm placing with you, is because I trust that the funds is going to come back. Once you start to doubt whether that will come back or not, then you run away. So Bamboo has built a very successful, I would say, app, right? And that's also because people have, over time, have not trusted them. I'm sure if you ask Yomo, for example, what the experience was in the initial days, folks would be very uncomfortable, putting their cards or transferring funds to them and all of that. But over time, things have changed, and maybe to also speak very briefly on the question you asked around how to build maybe a smart financial market. And I think he mentioned it. I think it should be based on collaboration and co-creation, to a large extent. Because if you think about it, rather than us fighting one another, right, we do have our strengths, as whether you're a bank or a fintech. So banks, for example, have like the balance sheet strength because we're allowed to take deposits and all of that. So our balance sheets are typically bigger, stronger than a regular fintech. Banks also do have, maybe should I say, stronger relationship with regulators. But the fintechs on the other side, what they really have going for them is speed and maybe user experience. They don't have some of the restrictions that we have as banks, right? So they are better able to get things out quicker and they get it, pushed into the market. So my point is that benefit, and they also have that distribution capacity, and maybe I can't remember now when your platform.
2019.
Okay. So 15 years ago, for example, if you wanted to buy Apple shares and you're a retail investor in Nigeria, I'm sure you have no clue how to go about it, But they brought something into the system, right? That gives you access as a retail investor. You may even buy less than one unit. So if Apple costs 1,000, for example, and all you have is $300 to buy whatever it is that you want to buy, you can actually buy a fraction of of that. They've made that possible. So the question is, the point is that rather than us as bank trying to say, oh, these guys are coming to take our bread, we should find a way to say, how do we plug into our system? How do I, for example, ensure that all of the monies that people are flowing into their wallet, right, that she opens an account with me?
We have APIs, so you can plug in now. Don't worry.
So, I mean, those are the things. So the point I'm trying to make is that it's about collaboration. So when we talk about smart investing and all of that, we need to be able to say, okay, how do we collaborate rather than trying to say we are competing? Even within banks, let's even leave fintechs aside. Bank A, Bank B, you really can't, there are things that Bank A has already spent money on. It could be technology, it could be capacity building, it could be whatever it is. Why can't you, as Bank B, just ride on what they have, rather than trying to go and build your own and spend a fortune trying to do that?
Right, that makes sense because at the end of the day, we're building smart investors together, and they want to operate in a smart environment. Thank you so much for helping us unpack this panel. I don't know if we have any questions at this point. Can we take Q&A? So you can put your hands up if you have a question for this incredible panel. Anybody? Okay. All right, I guess we've been able to cover
about online
as much.
If there are questions online.
Online, do we have questions online?
No, say none.
No questions online. Fantastic. I guess we've been able to cover good ground here. Thank you all so much for this opportunity, and thank you again, FSDH. All right.